Hi, everyone, and welcome to another episode of the M&A Mastermind Podcast, your go-to source for the latest industry trends and strategies to help you level up your M&A practice. Again, I am your host, Nick Olsen, Managing Director of Cornerstone International Alliance. We are a consortium of 27-plus lower middle market M&A firms who band together to help each other do great things in this M&A space. We also bring on this podcast guests who are true masters of their craft, expertise in the M&A industry. And today's guest definitely fits the bill there. So I'd like to welcome our guest today. He's a great guy. I got to know him over the last couple of years. He comes from the other side of the negotiating table, so you guys might have seen him in deals that you've done in the past. He is a director at Lead Capital Partners in Nashville. He is on the board of directors at M&A Source. He received his master's degree in business administration from the University of Chicago. I'm seeing he is a former U.S. Navy intelligence officer. Please welcome my guest today, Lamar Stanley. Lamar, how you doing?
Great. Thanks for having me, Nick.
I appreciate you joining, taking some time out, and talking about a really cool topic. What are some common deal killers that you're seeing, that we're seeing, and that are impacting how the deals may not get done? So I want to start out by saying, again, thank you for coming. You are with Lead Capital Partners based in Nashville, Tennessee. Why don't you tell us a little bit about yourself, a little bit about Lead Capital Partners, and what your focus is and what kind of deals you're looking at right now?
Yeah. Well, you covered me pretty well. I'm not from Nashville, where Lead Capital Partners is located. I'm actually originally from Mississippi, as you can probably hear, but about 10 years ago, like everybody else, I moved to Nashville. And I joined Lead, though, about 2 years ago. And what we focus on specifically are lower middle market healthcare opportunities. And we define healthcare pretty loosely. Everyone has things that they like more or less, and we certainly gear closer to the healthcare services side of healthcare. But that said, I always tell people who are looking at healthcare related opportunities to take on for clients to let us see it. Our investors, they like investing with us, one, because we're in the lower mid market, and two, we are targeting the resilience of the healthcare industry. So while we do prefer healthcare services related opportunities, anything touching healthcare might be a fit for us. So I always encourage people that if it's got any type of healthcare stink on it, give me a call and we can talk it over. But on that note too, I do like to point out another key differentiator or key element of our strategy is our long-term hold focus. So our origin story is we were backed by 5 family offices that got us off the ground. And the intent is to buy things and then hold them, we say forever, but really what we're talking about is 10 plus year increments. And the logic is we're going to hold them as long as, we are the right owner for the business, and we want to hold winners as long as we can keep them that way. And so, in our mind, it doesn't make sense to sell great businesses. And that was frankly what frustrated me at my old firm, is that, we would have a great business, and just because the fund lifespan expired at a certain point, we needed to exit and harvest those investments. And as someone who spends a lot of time trying to source great deals, it's just, you hate to see the great ones go. And so that's the benefit of Lead's model. And for the owners that we're working with, we can look them in the eye and say, hey, look, we're probably going to be the last partner that you have. So that's a different message than folks who say, we're going to flip this thing in 3 to 5 years and hopefully make you a ton of money. Well, we're hoping to do that and not put you back on the dating scene 5 years down the road. So enough about Lead. Happy to be on here, Nick, but appreciate you talking to me about this.
Yeah, and it kind of go off what you just were introducing about Lead, and you guys are healthcare, like you said. What intrigued you about the healthcare industry that you guys are focused on that space?
Yeah, that's a great question. Lead actually did not originate. The first deal that Lead ever did actually was a pool lifeguard management business. So not at all healthcare, or at least hopefully not healthcare. I guess you could spin it that a lifeguard does administer healthcare at some point, but hopefully not very often. No, but like anything in Nashville, we ultimately got pulled into the healthcare vortex, and we really consider that a key benefit of where we are. You could argue that funds that are in San Francisco really have an edge as it relates to software, and funds that are in Houston have an edge as it relates to energy. We feel the same way about Nashville and healthcare. We go to school. I'm saying our kids go to school. We go participate with sports teams with kids around a lot of healthcare executives that can give us edges. And we're just buddies in social circles with a lot of people who can get us smarter on a lot of topics very quickly. So it's an environment here that really is conducive to us having a higher understanding of some of these specific healthcare services markets. And even if I don't know someone in a industry that we're looking at, I can get tight pretty quick, just with a handful of phone calls with folks that I could probably, throw a stone at and hit somewhere in the blocks around me right here where I'm sitting.
Mm-hmm. Yeah, no, I appreciate that. And I know you've worked with a lot of our group too, and I've heard lots of great things about, yourself and your firm, and just your professionalism, and like you said, really great reputation on the longer hold of the businesses. So I think that definitely, I would agree, sets you guys apart, and would definitely recommend working with you and your team.
Really glad to hear that.
So one thing, when you're looking at investing in a company, is the owner's continued participation in the growth, right? Can you explain what that means and why that's important why that's important to you and Lead?
Yeah. So getting back to our long-term hold strategy, if you sit down with me, Tate, Pryor, or Carl, any of my group here, you are going to hear the word alignment at some point within the first 5 minutes. And we think about alignment a lot as it relates to both our investor base, to our partnership here, to working with partnerships with owners. It is just critically important, in our opinion, for businesses to be successful. There has to be proper alignment. And so in that regard, we don't love the idea of just taking on a business and an owner, tossing us the keys and walking out the door. Or if there is going to be a scenario like that where we're going to get involved, there's another layer of management who we can help kind of take the baton with and carry it forward together. We just feel like that's critically important at our end of the lower middle market. There are plenty of public companies that you could lop off the C-suite from, and it would continue to march on without even a stutter. For the businesses that we're looking at, and the way we define lower middle market is 1 million of EBITDA to 5 million of EBITDA is where we spend most of our time. Yeah. So in those businesses, culture matters, and we have to have some continuation of the old life, bringing it into the new Lead life. And people need to know, who the critical players are, where the bodies are buried in some cases, what struggles we've had when we were trying to attack a new market. And we firmly believe that we're going to be standing on the shoulders of the forefathers of the business. And so we want to keep that corporate knowledge around. And so the best way to do that, obviously, is to get those members of the management team or the old ownership, keep them in the equity. And we want them to benefit alongside us as we continue to grow the business.
And the ownership group, the management team, I think is going to be one of your answers here. But for the advisors, M&A advisors listening to this episode, what are other criteria that you look, from a high level of businesses that you guys want to target?
Yeah, so the management team is a big part. We really like to see steady cash flow, and I realize we're not unique in that regard, but it's not just the number. So many times we're looking at businesses, particularly around software serving healthcare, or like RCM businesses, or things that tend to be a little bit more technical. They might be transforming the business in the year prior to us getting a look at it, and that turns us off a little bit, just because we like to see something that's been proven out. So even if the cash flow stayed the same, if they've totally changed their model in the past year, that makes things more difficult for us.
Mm-hmm.
We also like to see, customer concentration is a big ticket item that we're going to look at very early in a process. We want to see that there's diversity in the customers, or if there's not, we want to hear that, frankly, the business is just as important to that customer as they are, or vice versa. So we look at that, we key in on that pretty quickly. And then, obviously every private equity firm, one of the most important things that we want to hear is, and I would tell this to a lot of M&A advisors. This is a critical part of their job, is we want to hear the story of the business. So going back to the origin and tell us the tale of this business, and include in that the last chapter is, this is where the growth is. We can probably do our best to try and figure that out, and we're going to, but help us figure it out. And that benefits your client when we have been told a story on how this thing gets to the next level. And frankly, this kind of goes back to my earlier point about bringing along management. Nobody knows that better than the management team that's in the business. They know where growth opportunities exist, and they also know where the false leads are that, will take you down a dark path maybe they've already traveled.
Yeah. And to add on to that, kind of secondary to that point, when you're projecting and you're looking at the growth potential of a business, like how do you want that shown? Whether it's in the conversations in the sim or whatever, like what makes it a real quote unquote projection as opposed to just kind of a pie in the sky we think we're going to get here kind of thing.
Right. Well, we do always expect to see the hockey stick, right? The projection that next year it's going to double. Yeah. So we always take those with a grain of salt. What tends to be a little bit more helpful is if there's already a demonstrated bit of growth from whatever that new opportunity is. So let's say that you just entered into, I'm in Nashville. Let's say a business has just broken into the Memphis market. If you can show over the past 2 years that there were this much sales in Memphis, and now this year there are this much sales, and you could project that out, that we're going to continue to grow until the Memphis market looks like the existing Nashville market, that's pretty compelling. And then similarly, if you can size whatever that market opportunity is. So let's say that you're bringing on a new product, not necessarily bringing in a new market. If you're bringing on a new product, how big is the market for that product? And, you could, sometimes you don't know. Nobody can predict the future, right? And that's what we always laugh to when business projections have 5 years out. I don't feel like anybody can predict 5 years out. But, if you want to size a market for a product, maybe you look at a competitor and say, this is how much they're selling. We feel like we could claw out 30% of their business, whatever. There are ways to make a pretty compelling pitch. And that's what I'm talking about when I say, we love to hear a story and explain to us why this is possible.
So what is realistic? 2-3 years down the road? Is that more realistic than 5?
Yeah, I think 2 or 3 is great. And then what I would also always suggest is we want to see at least as many years in the past as you provide us in the future. So if you're projecting out 3 years, then we would assume that you're going to show us at least 3 years, maybe 4 in the past of financials.
That's really good to know. That's a good point. So we're kind of talking about the things, the positive, side of it. We're here to talk about the deal killers, right? And so what are some things when you're going through the due diligence process, what are some things that you guys are looking to uncover? Like you said, maybe the all the stuff that could come, up in due diligence that you want to get out in front of it early, I guess would be probably one thing you want to look at. But what are some things you're looking to uncover?
Yeah, the first thing, I've already mentioned a couple, like the customer concentration bit. If the business is changing, that's a critically important deal or issue. What we're trying to uncover is a difficult one to answer. It's kind of like gosh, I can't believe I'm a liberal arts major and I'm about to utilize it. The Anna Karenina quote, it's all happy families are alike and unhappy families are different in their own way. So there's a lot of ways that a deal can get screwed up, I guess is the point.
Yeah.
Not a very good analogy, I suppose. But but you kind of get my point, is that
Mhm.
there's a lot of things that you could uncover and it'd be hard to list them all. But that said, the one thing we do try and get to really quickly, actually, now that I'm thinking about it, is expectations. And what we want to know is this seller a real seller? And there are plenty of sellers, and I'm sure you can speak to this much better than I can. There are lots of sellers that think they're a seller, but their number is not reasonable. That, so yes, they're a seller at a certain number, but the truth is no one's going to come within 40% of that number. That's not a seller. And so that's one of the first things we try and get at. Not that we need to hear what your valuation expectations are, but we want to talk to them and hear what their expectations are for the process. So if it's, hey, I want to close this thing in 3 weeks, say, well, but I got bad news. That's not going to work. That's not going to happen. If somebody's telling us in December that they want to close by the end of the year at the first meeting. So those types of things are critically important. I also, this is kind of less about what we're trying to uncover and more about what's just general deal killers. And this kind of goes with expectations loosely, is we just want to make sure that we're trying to manage trust, not only because we're going to be partnering typically, and so we need to keep the relationship great, but it's very difficult for us to move through a process and, by the way, spend the money on diligence all along the way if we don't feel like we're being negotiated with in good faith. If we uncover things that are, I'll use the word problematic, then without them offering them up initially, that jeopardizes the process, in our opinion, just because we want to know that all parties are kind of being forthcoming with everything they're doing. And that works for us too, by the way. If we bump into an issue, we are pretty adamant about, and we feel like this is a lot attributable to, a lot of leads success is attributable to this, is we try and get right out there with bad news. We want to come early and often with the bad news, just because letting it linger is not healthy. If we're not seeing cash flow where the seller says it was, we want to talk about it immediately. And the reason we want to is we don't want to, be sitting on something that ultimately is a deal killer. So,
yeah, that's and you kind of hit on this too, but my next question is, as M&A advisors, what are maybe you give us an example or two that maybe have a negative, experience you had where you wish they would have brought some information out, early, because like you said, the earlier the better. I know we both know Scott Bushke, our founder, and I always hear him say, "Go dirty early," and so that's very true, because you guys, from your perspective, you want to uncover all that early on. So not only can you, obviously, unveil that, but really talk through it. Maybe there's a resolution as to how you can, fix it, or there could, turn a maybe not a great component of the business into a positive, where you guys can help, maybe improve that if you are the successful buyer.
Yeah. A good example of that was a few years ago, or I guess 2 years ago. We were looking at a physician practice. They had 3 locations, and they had actually opened a 4th and then closed it. And which is fine. It happens all the time. We look at a lot of physician practices that try new markets and ultimately either can't staff it, or there's just not enough market demand in that location, so they shutter it. And depending on the physician practice, you can do it at a fairly reasonable cost, just kind of test markets, that type of thing. Well, these guys didn't disclose it. They didn't talk about it. And oh, by the way, that's fine, I guess, but it was also, what made it a little bit of a frustration for us was they were also talking about kind of growth opportunities around opening practices other places. And so that feels like a relevant detail that they've actually tried to open in one geography and it didn't work. Now, this is a perfect example of, kind of to your point about going ugly early or go dirty early, is if they had led with that and said, hey, it didn't work for these 3 reasons. And oh, by the way, we learned these 2 things about, de novo new locations, and we will be super successful in this location, and this is why we think so.
Mm-hmm.
You know, that really is pretty compelling,
Yeah.
but it's not as compelling, and it also kind of fractures trust in some cases if we find out later, say, wait, we found in the data room that what was this? And they say, oh, we tried to open this location. Okay, well,
Yeah.
let's talk about that. You know, what
Right.
happened there? And so it just kind of then we start to rack our brains. Say, all right, well, what else are we missing? And this kind of gets to another deal killer too that I was thinking about as you were talking earlier. The other one that you'll hear every M&A advisor say is time. Time is the number one deal killer,
Mm-hmm.
and we are firm believers of that too. Bringing those things up, that's just time, you know,
Yeah.
and at some point deal fatigue sets in because we start looking at what we've learned just through the diligence process. And we say, what else are we going to find out? You know, these guys aren't being necessarily that forthcoming. Is this the best? Because we're a lean team. And so we can't work on deals that aren't necessarily going to close.
Mm-hmm.
And so that's the big concern for us when the timeline for a deal starts to really slide.
What are some other things that you see that I guess kind of compiles the taking more time, you know, kind of the deal kill or time kills all deals? What are other things that you see advisors do or their clients do that kind of prolong the process?
Yeah. So one is just preparation. I'll quote an old gunny in the Navy, the guy who stood over me for 3 months at OCS. Going slow is smooth and smooth is fast. That would be my recommendation to a lot of M&A advisors is don't necessarily rush to market.
Mm-hmm.
Go slow, get the data room filled, prepare all the documents that you know people are going to ask for,
Mm-hmm.
and then launch. Because if you launch and these things aren't ready, then we're going to be requesting documents that the owner can't yet provide. And oh, by the way, they're still trying to run their business. So they're diverting attention from that.
Yeah.
It's better just to have everything prepared. And then that way we don't spend time during the deal process trying to come up and we're sitting and waiting and wondering if the owner has lost interest or what's happening on the other side of the curtain.
Right.
It's much better to have all that stuff set out. The other piece is if, you know, our meter is running. And so, you know, you could argue that we'll spend the same amount if it takes 10 minutes or if it takes 3 months. So that's not necessarily the case. There are some things that cost more money if the process continues to slide. So now, yes, you could make an argument at some point if we've spent enough money, we're pregnant. But I don't think there's any private equity fund that feels that way. You know, if they sense that it's a bad deal and time is going to eventually take it down, then you know they'll walk away.
Mm-hmm.
One other thing too about the time is, you know, you're buying future cash flows and future cash flows assessed at this moment. If a deal process takes a year, I mean, I would be hard pressed to find any business that the picture of what projected cash flow looks like, it changes if you take too long. And so, you know, if you get a deal done in 2 months, that's much better than a year, because some of the work that let's say you started January 1st and didn't close until the end of the year. Well, some of the diligence that we did in February, probably, I'm not going to say it needs to be redone, but there might have been things that change or perspectives that change in that period. So it's best to just get things moving as quickly as possible.
You know, I want to go back to your point about being prepared, like take the time, go slow, prepare. And I got to imagine if you get into a situation where they're not prepared and you're asking for documents and, you know, they're taking time to get it, you know, that's got to add a bunch of frustration on both sides. From your side, you know, from even the business owners getting frustrated, obviously, you know, the advisors getting frustrated, like that just adds a whole nother dynamic to beyond just the longer it takes, right?
Yep. That's actually a even better point. And I'm glad that you brought that up because I forgot to say that. We hate it as much as the advisor hates it because it makes us look like we're sharpshooting the owner. When we say, hey, look, can we get the financials from the year before COVID? Because there's so much noise in here. That's something that they probably should have anticipated. And then it makes us look like we're accusing the owner of not having his stuff together, and then similarly, like customer concentration metrics, we start to look like the good idea fairies when we're saying, hey, can we get these broken out? And then they give us kind of a lackluster answer, be like, okay, but can we get the next 10? And then we start to sound like just the squeaky wheel that's bothering the owner. Whereas if the M&A advisor said, hey, look, they're definitely going to want to see this. Yeah. Let's go ahead and get it done. Then the owner, and this goes back to the expectation management piece, the owner doesn't look at us like just a big, nagging buyer. Now we look like the guys who are asking for exactly the things that the M&A advisor told them we would ask for. So it's just a little bit different when you've spent time preparing. Also on that note too, one plug, a big alleviator of all of this issue is just a sell side Q of E. We're going to look a lot less. We're going to be much more inclined to accept data and numbers if we know that a sell side Q of E has occurred, and also the guys who are going to be doing our Q of E, the buy side Q of E, they're going to be a little less likely to try and punch holes in something if they know that another CPA has dug through it. So granted, it costs money, but a lot of times, most times, in my opinion, it pays for itself pretty quick.
Are you seeing more sell side Q of E's nowadays, or is that something that's shifting, or would you still like to see more of that?
Yeah, I mean, we still don't see them in all cases. Most of our deals, frankly, don't have them. So I can't say that we're seeing more.
Yeah.
But I'll just tell you, we are a professional buyer and seller of companies, and we would not consider selling a company without executing a sell side Q of E. So take that for what it's worth.
That's good advice. That's good advice. And I think, you mentioned, kind of taking another step back, I just wanted to hit on this. You mentioned COVID, financials pre-COVID. Is like, from your perspective, is that still an important component? You still want to see financials pre-COVID, or are we kind of beyond that, or not quite yet?
Yeah, I mean, it depends on the business, right? But we're probably there for some businesses and not for some others. It's kind of like in my old firm, I used to kick myself frequently. I mean, I still did it, but we would ask about as late as 2015, we were at 16, we were asking. Actually, I guess later than that, honestly, but we were asking about how things went in the downturn, 2009, 2010. And so we had to stop ourselves at some point. We said, look, this is just a different era at this point. So that's no longer relevant, or this business really didn't exist in its current form back in that era. So we're probably getting close to that, where you can see some pretty true numbers coming out, but it never hurts, especially if it enhances the story that you're telling, Nick. This is what happened during COVID, and now we're back to where we were in 2019, and you can see a 5% increase. Like that, in our opinion, helps you probably more than it helps us, just because you can show with a dotted line kind of what it would have looked like had the world not gone off a cliff in March of 2020.
Yeah. How did COVID affect healthcare, and how is healthcare kind of rebounding from that, based on the effect that it had?
I mean, it's there are huge differences. I mean, like if you ask a dentist office where their revenue went to zero in April of 2020, they can show you kind of how it impacted, and there was just a backlog of clients, and then they had to get all their patients back in the house. But there are some sectors that weren't impacted or were greatly enhanced, like urgent cares, for example. Like we're looking at a group of urgent cares right now. That the hard part when you're looking at urgent cares in the post-COVID era is you try and figure out what is COVID pop and what is actually sustainable revenue. can't think of other examples, but it's a lot like the rest. I mean, like industrials markets that I used to work in, is that it varies. I mean, there are some that benefited quite a lot, and then there are some that really suffered during COVID, and it's just it different strokes.
Mm-hmm. Absolutely. Yeah, I mean, just I think just in general, people are getting more back to the I guess elective might not be the right term, but just the the maintenance, the necessary stuff, the physicals, the teeth cleaning, all that sort of stuff. I think that's getting way more back to normal than what you really necessarily couldn't do during COVID. So I guess that's a good thing.
No, you're right. I mean, in that regard, we're seeing there are no real remnants of. We are definitely in a post-COVID era where the dental practice's performance right now is about what you should expect.
Mm-hmm. And so, man, this has been amazing insight. So I appreciate that. I've definitely learned some things here, and hopefully our listeners have as well. Let's fast forward to 2024. What are you seeing? What are you projecting? You guys at Lead, what are you guys projecting for 2024 as far as just I guess first deal volume? Are you guys expecting to have a good amount of deal volume? Low? I guess what are your thoughts?
Yeah, we are expecting a lot of deal volume to come in the first quarter of 2024. A pretty common refrain that we're hearing from M&A advisors is that, well, first, let me tell you what we've seen this year. The first half of the year was really, really slow from a deal flow perspective. Mm-hmm. It picked up after Labor Day-ish. And so we've seen a big push of deal flow. And then we are hearing from a lot of M&A advisors that business owners are looking to do something in the first quarter of 2024. Now, what that's attributable to, again, it varies, but our sense is there was just a lot of uncertainty. Business owners were working this year to get their businesses back to steady state post-COVID era, demonstrates. And then the biggest thing in the healthcare sector is they wanted to get a year under their belt demonstrating that, things are back to normal. Mm-hmm. And then you compound on that, interest rates rising. A lot of M&A advisors were hesitant to bring deals to market if they felt financing markets weren't going to be able to be there for buyers like us. But I generally think now people are pretty comfortable about the availability of debt. The world is not getting any more stable. So people are pretty anxious now to bring things out kind of early next year. So my hope is that my phone rings off the hook in January. We'll see.
Maybe we'll scroll that cell phone across the. I'm kidding.
That's right. And I also caveat that by saying, what could possibly go wrong? Because I remember saying stuff similar to this in February of 2020 about how busy we were going to be that spring, and then the world ended. So, I got to stop making predictions.
You never know, right? Hey, predictions are fun to make sometimes.
That's right.
I'm gonna have you make another prediction. What about what are you seeing or projecting on multiples for 2020?
Yeah, so mechanically multiples should be going down, right? Just because debt's more expensive and there's less availability of debt, and there are fewer deals. So that actually, I guess, will bring multiples up. But our sense is that multiples are holding steady about where they've been over the past year. We were expecting maybe some discounts, but that just hasn't come to fruition. Our best explanation for that is there's just a lot of dry powder still out there. There are just fewer deals, the same number of firms out there. If you look back at 2021 in particular, that was a record-breaking fundraising year. So all that dry powder is standing by, and deal flow has been light. So folks need to get that capital deployed. And for that reason, multiples have been holding steady in spite of increasing interest rates. If anything, maybe in certain sectors, multiples have gone up. So we expect more of that. I mean, there's just a huge backlog of dry powder that's going to get deployed in the next year or so. So we're trying to pick our spots. And this goes back to our, expectation that we do have edges in certain sectors where we feel like we understand or we can see the ball a little bit better than most, just due to our experience in healthcare markets as well as sitting in Nashville. So we're hopeful that we're going to find 2 or 3 spots again next year where we can deploy some capital.
Yeah, that's awesome. Yeah, hopefully with one of our CIA members.
That's right. Right. That's awesome.
Or the right opportunity. Yeah. So Lamar, I appreciate your time today. Great insights. I always love hearing. We're primarily sell side M&A advisory firms. It's always great to hear your perspective from the opposite side of the table. I learned a lot. I'm sure our viewers learned a ton. How can our viewers get a hold of you? How can they reach out to you? Where can they find you? All that fun stuff.
Yep. You can find us at leadcp.com, not lead, lead, leadcp.com. We joke whenever we're having a bad day around here, we're Lead Capital Partners, but you can find us on our website, leadcp.com, and you can find me. And like I said, we're a small team. We're all good at sweeping the floors or closing deals. So you can reach out to any one of us and we'll be responsive. Happy to talk to anybody. And even if it's not a deal, if you just want to brainstorm about certain things, we love having those conversations. Frankly, we learn as much as we teach a lot of times in certain healthcare services sectors when folks are new to an industry. So we're always happy to talk things over with folks and try and be helpful whenever we can.
That sounds great. I mean, that just epitomizes what you guys are as a firm, as people. I think that's shown, shining that out as you guys are great people and great to work with. And I would echo that in the interaction that you and I have had. So really appreciate you joining the M&A Mastermind podcast today. A true mastermind, if I can say so myself. You, not me. And I appreciate everybody listening in, joining. Please like, share, and comment on this episode. You can find all of our episodes at cornerstoneia.com. Lamar, thank you again. And until next time, hopefully we can get some more deals done.
Great. Thanks a lot. Appreciate having me, Nick.